Look, I'm going to tell you something that's going to sound insane at first. There's a fifth stage coming in the silver market that nobody's talking about. Not the analysts on CNBC, not the guys running billion-dollar funds, not even the people who lived through 1980 when silver hit $50 an ounce and then crashed so hard it took 40 years to recover. And here's the thing that should make you pay attention. We've already gone through stages 1 through 4. Right now, in December 2025, we're sitting in that strange moment between the 4th and 5th stage. And if we can learn anything from history, this 5th stage is about to turn everything we thought we knew about silver completely upside down. The Hunt brothers squeeze from decades ago? That's going to look like child's play compared to what's heading our way. But before I break down what this 5th stage actually means and why there's no way to avoid it, let me make something crystal clear. Silver isn't just some decorative metal people turn into rings and necklaces. This is the most controlled, least understood, and potentially most volatile commodity you'll find anywhere on Earth. The situation developing right now has literally never happened before in all of recorded history. Let me take you through the 4 stages that are already behind us. If you don't grasp how we arrived at this point, you're never going to believe what's about to unfold next. Stage 1 kicked off back in 1999. Silver was changing hands at $5 per ounce, $5. You could pick up an ounce of silver for less money than you spend on a decent lunch. And somehow, everyone just accepted this as perfectly normal. Mining operations were filing for bankruptcy left and right. Precious metals were completely off everyone's radar. Gold was considered finished. Silver was written off as worthless. But something began shifting that year, something that would eventually change the entire game. Central banks, which had been dumping gold for 20 solid years, abruptly stopped selling. The Bank of England had just unloaded half their gold reserves at rock-bottom prices, $275 per ounce, probably the worst financial decision in recorded history. And that massive mistake signaled that we'd hit absolute bottom. Silver started its climb, slowly at first. $6, $7, $8. Nobody was paying attention. But the people who actually understood money were quietly accumulating. By 2003, silver had reached $5.50. Still incredibly cheap, still completely ignored by mainstream investors, but the foundation was being laid. Stage 2 exploded in 2008. The financial crisis hit. Lehman Brothers went under. Bear Stearns disappeared overnight. IG needed a government rescue. And the Federal Reserve took an action that had never been attempted before in history. They created $4 trillion from nothing to prevent the banking system from total collapse. Silver rocketed from $9 in November 2008, all the way to $49 by April 2011. That's a 5 times increase in just 30 months. Everyone called it a bubble. They said it was pure speculation. They predicted it would crash exactly like it did in 1980. And you know what? They were absolutely right. The price collapsed hard. By 2015, silver had fallen back to $14. Anyone who bought at the peak lost 70% of their investment. The mainstream financial media declared silver dead once again. Just another failed speculation. Another bubble that burst and disappeared. But here's what every single one of them completely missed. Stage 2 wasn't really about the price climbing higher. Stage 2 was about demonstrating that when central banks start printing massive amounts of money, real physical assets react. When you manufacture trillions of dollars out of thin air, people run toward things that cannot be printed on demand. And silver responds faster and more dramatically than any other metal on the planet. Stage 3 began in 2020, March 2020 to be exact. The entire world shut down. The global economy stopped functioning. And central banks everywhere did something that made the 2008 response look like a practice exercise. They printed $18 trillion in just 2 years. The Federal Reserve alone printed $5 trillion. That's more money than they created during the entire 10-year period following 2008, all of that in 24 months. And it wasn't just the Fed. Every major central bank on the planet opened up the money spigots. Money creation on a scale that humanity had never witnessed before. Silver reacted exactly like it did during Stage 2, except the movement happened much faster. It jumped from $12 in March 2020 to $30 by August 2020. That's a 2.5 times increase in just 5 months. But this time around, something fundamentally different occurred. This time, regular everyday investors got involved. Wall Street Bets, that Reddit community that became famous for the GameStop situation, turned their collective attention toward silver. They started purchasing physical silver. They started buying shares of SLV, the largest silver exchange-traded fund. They completely overwhelmed the websites of every major precious metals dealer in the country. You literally could not buy silver anywhere. Premiums shot up to $10 above the spot price. People were spending $40 for silver that was officially trading at $28 on paper markets. The squeeze was happening in real time, and then suddenly it stopped. The price retreated. Not all the way back down, but enough to shake out the weak hands. Enough to make it appear like another failed attempt. By late 2022, silver had dropped back to $18. The media announced that the squeeze had failed. They said retail investors had given up and moved on. They declared it finished. But Stage 3 was never about the squeeze itself. Stage 3 was about something far more significant. It proved beyond any doubt that retail investors possessed the power to actually move the silver market. For the first time in history, ordinary people demonstrated they had sufficient collective buying power to potentially break the paper pricing mechanism. Stage 4 is unfolding right now. This is the stage that nobody seems to be discussing, but it's actually the most critical one. Stage 4 is about supply and demand fundamentals that cannot simply be manipulated away with paper tricks. Let me give you the actual facts. Global silver mine production hit its peak back in 2016 at 900 million ounces. Right now, we're down to 830 million ounces per year. Production is actively declining. Why is this happening? Because the majority of silver comes as a secondary product from copper, lead, and zinc mining operations. When those base metals aren't profitable enough to mine, you don't get the silver as a byproduct either. Plus, the easily accessible deposits have been exhausted. Meanwhile, demand is absolutely exploding. Industrial demand for silver has reached all-time record levels. Solar panels need silver, electric vehicles require silver. 5G infrastructure depends on silver. Every single electronic device you own contains silver components. Industrial demand by itself is consuming 600 million ounces every year. Then you have to add investment demand on top of that. Exchange-traded funds are holding 700 million ounces. That's been accumulated over the past 20 years, but it's still sitting locked away in vaults, completely unavailable for industrial applications. India and China are importing unprecedented amounts for jewelry manufacturing and investment purposes. Central banks in various countries are beginning to add silver to their reserves. Do the simple math here. 830 million ounces of production. 600 million ounces of industrial demand. Plus investment demand piled on top. The market is running a deficit. We're consuming more silver than we're producing every single year. This has been happening for 5 consecutive years now. And here's the part that should really get your attention. Above-ground stockpiles are being depleted at an alarming rate. The COMEX, where silver futures contracts are traded, currently has 250 million ounces in registered inventory that's available for physical delivery. That might sound like a substantial amount until you realize that industrial demand alone would consume that entire stockpile in just 5 months. Stage 4 represents the setup. It's the stage where the fundamental supply and demand situation becomes absolutely impossible to ignore. Where the paper market that has controlled silver pricing for decades starts showing serious cracks. Where the gap between paper silver contracts and actual physical silver starts widening into an enormous chasm. We're living through Stage 4 right at this moment. Silver is currently trading around $31. It's definitely up from the 2020 lows, but it's nowhere close to the 1980 peak of $50, and it's nowhere near the 2011 high of $49. Everyone assumes silver is just stuck. Everyone thinks it's destined to trade sideways indefinitely. They're completely wrong. Stage 5 is approaching fast, And Stage 5 is going to be unlike anything the market has ever experienced. To really understand what Stage 5 looks like, you need to understand the true story of what happened in 1980. Everyone constantly compares silver squeezes to the Hunt brothers situation, but almost nobody actually knows the complete real story. And the differences between 1980 and today are precisely what makes Stage 5 absolutely inevitable. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires. They inherited massive wealth from their father, Hunt, who was among the richest men in America. During the 1970s, they made the decision to buy silver, not just a little bit of silver, a tremendous amount of silver. Their logic was straightforward. Inflation was spiraling out of control. The dollar had just been disconnected from the gold standard in 1971. Oil prices were spiking dramatically. They believed paper currencies were headed for collapse and precious metals represented the only real form of money. So they began buying aggressively, not just futures contracts but actual physical silver. Real metal bars delivered to warehouses in New York and Switzerland. By 1979, the Hunt brothers controlled 100 million ounces of physical silver. That represented roughly half of all the silver available for delivery in the entire United States. The price responded dramatically. Silver was $6 per ounce in January 1979. By September, it had reached $10. By December, it hit $20. By January 1980, it peaked at $50. An 8 times increase in 12 months. Everyone panicked. The Commodity Futures Trading Commission intervened. The exchanges rewrote the rules. They implemented something called Silver Rule 7, which restricted new long positions. You could sell silver contracts, but you couldn't buy new ones. They increased margin requirements dramatically. They made it financially impossible for the Hunts to maintain their position. And then they delivered the knockout blow. Volcker's Federal Reserve raised interest rates all the way to 20%. Borrowing money became so expensive that leveraged positions collapsed across the board. The Hunts were forced to liquidate their holdings. Silver crashed from $50 to $10 in just 8 weeks. The fastest commodity crash in recorded history. The Hunts lost billions. They filed for bankruptcy. And for the next 40 years, every single time silver started rising, people would say, "Remember the Hunt brothers. It's going to crash exactly like 1980. But here's what nobody ever tells you. The Hunt brothers squeeze was a concentrated attack by 2 billionaires using leverage and futures contracts. They controlled the market through paper positions that were backed by physical delivery demands. And when the regulatory rules changed, they couldn't hold their position anymore. Stage 5 is going to be completely different in every possible way. Stage 5 isn't 2 billionaires acting alone. Stage 5 is millions of retail investors worldwide. Hundreds of institutional investment funds, industrial users desperately scrambling for supply, and a physical shortage that cannot be covered up with paper contracts. Let me show you the actual data that proves this beyond any doubt. In 1980, global silver inventories were absolutely massive. Government stockpiles alone held billions of ounces. The United States' strategic stockpile had been accumulating silver continuously since World War II. India had enormous inventories. China maintained substantial state reserves. When the Hunt brothers drove the price to $50, all of that inventory flooded into the market. Governments sold their holdings. Private individuals melted down silverware and jewelry to sell. Supply poured in from everywhere, and the squeeze broke under the weight of that supply. Today, those massive inventories simply don't exist anymore. The U.S. strategic stockpile is completely empty. It was sold off during the 1990s and 2000s to raise funds. India's silver imports over the past 20 years have far exceeded their exports. That silver has disappeared into the country, melted down into jewelry and religious items that will never return to the commercial market. China transformed from being a silver exporter into being a massive importer. Their above-ground stocks are depleting just like everyone else's stockpiles are shrinking. In 1980, there was virtually no structural industrial demand. Silver was used primarily in photography and some electronics, but that was basically it. When the price spiked dramatically, Industrial users could simply cut back their consumption or substitute alternative materials. Today, industrial demand is absolutely structural and non-negotiable. You cannot manufacture a solar panel without using silver. You cannot build an electric vehicle without silver components. 5G infrastructure requires silver. There is no viable substitute available at scale. When the price spikes this time, industrial users have to continue buying regardless of price, or their entire supply chain completely shuts down. In 1980, silver exchange-traded funds didn't exist. If you wanted exposure to silver price movements, you either bought physical metal or you traded futures contracts. Today, SLV alone is holding 500 million ounces. PSLV holds another 150 million. Sprott Physical Silver Trust, various European ETFs, they're all holding physical silver locked in vaults. That as 700 million ounces that has been permanently removed from the available market and is coming back into circulation unless prices climb dramatically higher. In 1980, retail investors didn't exist as any kind of coordinated force. The hunts were operating completely alone. Today, millions of retail investors are literally one social media post away from coordinated buying action. We witnessed it happen in 2021. We're seeing the early signs of it happening again right now. And the next time it happens, there simply won't be enough physical silver available to meet the demand surge. In 1980, regulators could change the rules and break the squeeze because it was concentrated in just 2 individuals. Today, the buying pressure is distributed across millions of participants located in dozens of different countries. You cannot change the rules on everyone simultaneously across multiple jurisdictions. You cannot force millions of retail investors to sell at the same time. You cannot shut down industrial demand that's built into manufacturing processes. Stage 5 is the moment when the paper market breaks down completely and permanently, when the gap between the price of silver on COMEX and the price of actual physical silver you can hold in your hand becomes so massive that the entire fiction cannot be maintained any longer. Here's where this gets really fascinating. The ETF data we have access to today provides us with a window into the physical silver market that nobody had, available in 1980. And what that data reveals is that we're far closer to stage 5 than anyone realizes. Let's start with SLV, the iShares Silver Trust. It's the largest silver ETF on the planet. Over 14 billion in total assets. It's supposed to be holding physical silver in vaults located in London. One share of SLV theoretically equals 1 ounce of silver minus management fees. In March 2020, when silver crashed down to $12, SLV was holding 480 million ounces. Then retail buying started accelerating. By February 2021, SLV holdings had grown to 670 million ounces. That's 190 million ounces of physical silver that had to be purchased and physically delivered to vaults in just 11 months. Really think about that number for a moment. 190 million ounces? That represents 23% of annual global mine production, purchased and delivered in under a year. To put it in proper perspective, that's more silver than entire nations consume over a decade. And here's the crucial point. Those 190 million ounces had to come from somewhere. They came from existing inventories, from refineries, from above-ground stocks that were sitting in London vaults or Swiss banking facilities. When SLV bought that silver, it removed it from the available supply permanently, because here's how ETFs actually function. They don't typically sell the physical metal. When people redeem their shares, the ETF has the option to deliver either cash or physical metal. Almost always, they deliver cash settlement. The silver stays locked in the vault. So, once silver flows into an ETF structure, it effectively leaves the tradable market, unless prices climb dramatically higher and the ETF chooses to liquidate holdings. Now look at what happened after that. In late 2021, silver prices pulled back somewhat. SLV started declining in total holdings. By late 2022, SLV was down to 550 million ounces. It had lost 120 million ounces of holdings. Everyone declared this proved the squeeze had failed completely. People were selling their positions. Demand was dropping off. Silver was dead once again. But examine what happened with the other ETFs during that same period. PSLV, the Sprott Physical Silver Trust, was actually growing. It went from 110 million ounces in early 2021 to 150 million by late 2022. People weren't actually selling silver at all. They were simply transferring from SLV to PSLV because they did untrust SLV as storage arrangements or corporate structure. Total ETF holdings worldwide didn't actually drop significantly. They remained elevated around 700 million ounces. The silver that flowed into ETFs during 2020 and 2021 didn't leave the market. It just moved around between different fund structures. And here's the absolutely critical insight that most people miss. Every single time there's a price spike, more silver flows into ETF structures and never comes back out into circulation. During 2008 and 2011, ETFs accumulated 400 million ounces total. During 2020 and 2021, they accumulated another 200 million ounces. Every market cycle, more silver gets permanently locked up in these structures. Meanwhile, industrial demand just keeps growing relentlessly. In 2015, industrial demand was 480 million ounces annually. In 2020, it had grown to 550 million. In 2024, it's reached 600 million ounces. That's a 25% increase in less than 10 years. Solar panel production alone is now consuming 150 million ounces every single year. That's up dramatically from 50 million ounces in 2015. Every solar panel that gets installed removes silver from circulation permanently. You don't recycle solar panels when they wear out. They sit on rooftops for 25 years and then they end up in landfills. That silver is gone forever from the market. Electric vehicles are consuming another 60 million ounces annually right now. Every electric vehicle manufactured uses approximately 1 ounce of silver in its electrical systems and components. Global EV production is ramping up aggressively from 10 million vehicles in 2022 to a projected 30 million vehicles by 2030. That demand is going from 10 million ounces to 30 million ounces annually just from automobile manufacturing alone. 5G infrastructure build-out, medical devices, water purification systems, electronics manufacturing. Every single one of these sectors is experiencing growth, and every single one requires silver as a critical component. Add it all together, 600 million ounces of industrial demand, 700 million ounces locked away in ETF structures, and mine production of 830 million ounces. The mathematics simply doesn't work out. We're running a structural deficit year after year, and we're drawing down above ground stockpiles to make up the difference. The COMEX registered inventory tells you everything you need to know about where this is heading. In 2020, COMEX had 400 million ounces available for physical delivery. Today, it's down to 250 million ounces. That's a 37% decline in just 4 years. At the current rate of depletion, COMEX will be completely empty by 2028. What happens when COMEX runs completely out of deliverable silver? What happens when industrial users cannot get their delivery orders filled? What happens when ETF buying spikes dramatically and there's literally no available inventory left to purchase? That moment is stage 5. Stage 5 isn't just another price spike that eventually reverses. Stage 5 represents a complete breakdown of the paper pricing system that has controlled silver for decades. And once that system breaks, it doesn't get rebuilt. Here's how the silver market actually functions right now. The price of silver is determined on COMEX through futures contracts trading. Traders buy and sell paper contracts where each contract represents 5,000 ounces of silver. The vast majority of these contracts never result in actual physical delivery. They're settled in cash. The paper market trading volume is roughly 100 times larger than the actual physical market. This system functions perfectly fine as long as physical supply remains abundant. If someone demands physical delivery, COMEX can source the silver from available inventories and deliver it. The paper price and the physical price stay aligned and matched. But what happens when physical supply becomes genuinely tight? What happens when industrial users start demanding delivery because they cannot source silver through any other channels? What happens when ETFs attempt to purchase 200 million ounces and there's only 100 million ounces actually available? The paper price and the physical price begin to diverge dramatically. Suddenly, you can buy a paper contract for $35 per ounce. But if you want actual physical silver delivered to your warehouse or doorstep, you're repaying $50 or $60 or whatever price it takes to find someone who is willing to part with physical metal. We witnessed early warning signs of this happening during 2020 and 2021. Silver was officially trading at $25 on COMEX, but retail dealers were charging $35 for physical coins and bars, a $10 premium over spot. That's a 40% gap between paper and physical pricing. That's absolutely not supposed to happen in a properly functioning market. The gap eventually narrowed and closed, but only because industrial demand temporarily slowed during the pandemic and some inventory came back onto the market. But next time around, that inventory won't exist anymore. Next time, the gap won't close. Stage 5 is when that pricing gap becomes permanent and irreversible. When physical silver trades at a massive sustained premium to paper silver because there simply isn't enough physical metal available to meet actual demand. And here's why it will make everything that came before look insignificant.